There's a lot of versions of the dollar, but the limit to its creation is not truly governed in any way. We have a Basel Committee, we have a Federal Reserve, we have a Treasury Department, and then banks themselves are self-regulating with their own risk departments. So there is a limit on how many dollars are created by all these institutions around the world, but that limit is not well defined by any one person, institution, country, or anything, and it makes the dollar really...
Nick Bhatia, founder of the Bitcoin Layer, is a leading expert in Bitcoin and global macroeconomics.
He authored the bestseller Layered Money and teaches finance at USC Marshall, specializing in Bitcoin and fixed income. A former US Treasuries trader, Nick holds a BA from USC, a master's in finance from IE Business School, and is both a CFA and CMT charter holder.
But then maybe just trying to dissect it again. Who's creating the money now in today's system?
It's a great question. My answer is changing all the time. I'm just going to be honest with you. Because even as you're asking the question, my brain is thinking that it's more a free-for-all. So to answer your question, the money comes from... Let me just suggest this, Pascal. I don't think we need a central bank anymore.
Yo guys, welcome back to Less Noise, More Signal. Well, today I have a really special guest again. It's a longtime follower of mine, so I've been following that person for quite some time, and it's nobody less than Nick Bhatia. Nice to have you on the show, Nick.
Pascal, thank you for having me. Appreciate it.
Yes, it's great to have you on the show because I've been, as I said, been following you for quite some time. We just quickly, before recording, we talked about it. You have struck me as somebody who's sort of, really interested into Bitcoin, which is obviously my interest as well, but then also beyond, like the entire macroeconomics, but then also in terms of the actual plumbing of how it all works, deep down in the financial system. And obviously, it's so vast, it's so complex and so complicated, and I feel like I sometimes I learn something, and then obviously I have to go back, revisit some stuff, and I feel like, okay, now I have to unlearn a few things again, and it's always this back and forth, and I hope that we can shed some light on this topic today with you, as you have also, I feel like, a similar journey, and you've just been grappling yourself with everything that's going on, right?
Yes, and I also have to constantly unlearn and really taking the approach that no one person can understand every component of global macroeconomics. I think that's the right approach, because if you think that you can one day capture it all, it might suppress your desire to learn. So I'm always trying to add a new component to my framework, and I'm under the impression that I'll be doing that forever.
I have the same feeling for me, as you said, exactly. It's like you want to learn ever more, and you never want to get complacent, and because you always want to stay curious. That's exactly how you learn. Well, great. So, but maybe for people who don't know you, could you maybe introduce yourself? Like, what are you actually doing? How do you make a living? And how did your interest for Bitcoin originally arise?
Yes, today I make a living as the founder of the Bitcoin Layer. We're a Bitcoin and global macroeconomic research firm. We have a YouTube channel that is free, available to everyone. It's also an audio podcast. We also have TBL Pro, which is a subscriber-only research publication that is targeting the quantitative understanding of how Bitcoin moves and why it moves, which involves global macro, rates, the Fed, and the economy, really. And so we're analyzing Bitcoin through a global macroeconomic lens. I'm an author. I wrote Layered Money and published that in 2021. And I'm publishing a new book this year, Bitcoin Age. It's done. It's in editing. So we're almost there, ready to release it. and I'm very, very excited about Bitcoin Age. I teach at USC Marshall School of Business as an adjunct professor. I teach both fixed income and a new Bitcoin class as well. My background before that and how I found Bitcoin, I was a rates trader. So I worked in the traditional industry. I traded treasuries for a very large manager and with large clients and, the largest tech companies, the state of California, for example. So I have experience of touching institutional portfolios with very large amounts of money, frankly. And this was, I did trades over $1 billion notionally, almost once a week for my entire career. So I have this is my background. And somewhere along the way as a trader, I stumbled upon a Wells Fargo equity research report that mentioned a few Bitcoin startups. And from that point on, I read it and I just became fascinated. And as well as I do, the rabbit hole and what that can do to people. And I fell down that rabbit hole. I never got out. And so somewhere along the way, I had to resign from my traditional job and go on my own way.
Nice. Yeah, very good to hear that story. I mean, yeah, just to kind of reiterate here, because that's really what you say, that's what I like about your approach myself. Like you have sort of this academic approach, I would say, and that's something you're also it feeds through into your publication that you mentioned. And we're really going to link to everything, at the Bitcoin layer, your YouTube channel. But there you have this academic approach, I feel like, which I really appreciate. But then at the same time, you are sort of a practitioner, as you said. You come from the industry. You've traded traditional instruments like bonds, as you said yourself. And that this unique blend, I feel is really valuable. So that's just awesome to have here.
And I love theory, Pascal, and that's really what drove me to become a writer and leave the trading desk. But the trader in me never left, in that I wake up in the morning and I'm looking at the candlesticks as the first thing I do before economic releases here in Los Angeles at 5:30 a.m. And so the fixed income trader in me never left, but I want to be someone that helps teach people. And so to combine those two things, I have to teach people that what people actually care about is returns, whether something is going to go up or down, and whether they can beat the average or the benchmark or not. That's literally all people care about in the investment world. So I try to combine those two things and teach my students and also the readers too.
Yeah. It makes a lot of sense. I mean, it's something, I don't want to get too philosophical here, but it's something I think the ancient Greek already, they discovered this. You can either have like theory and no practice, so to speak, but then obviously, as you said, you're maybe far off from reality, and then exactly the people who want to know the actual stuff and where prices are moving, then if even you have like a really sophisticated theory and it doesn't really match what's happening in the real world, it doesn't help. But then on the other side, if you are sort of only a practitioner and you have no theoretical background, then I feel like you're just aimlessly walking around and you could be really going down a wrong route, so to say, or route. And that's why I think the combination of both is so important, because they sort of depend on each other. They're sort of independent or like interdependent, that you have to have both. So that's certainly very interesting. I mean, one thing I would like to circle back just quickly, because your book, you mentioned it. Can you maybe just quickly say the Bitcoin Age, what is this going to be about?
Yes, Bitcoin Age is what I'm trying to build, is the authoritative story of Bitcoin and where it came from. So Bitcoin came from a history of internet protocols. Of course, Bitcoin is an internet protocol. So I tell the story of internet protocols and where Bitcoin came from. But Bitcoin addresses a problem. It's the solution to a problem. And that problem is that money is now credit money. And so we don't have pure money anymore. And you can say all you want about gold. Gold has a rich history as money, but Bitcoin is the future of money. And today, credit money has convinced people, or let's just say this, people believe that their credit money is money, but it's working against them. It's working against them. It's disadvantaging people because they have been tricked to believe that credit money is money. And it's just not. And so I tell the origin of the problem, the source of the problem, which is the dollar becoming a credit money system and how that happened, and blend that with the story of Bitcoin and the rise of Bitcoin. I also am very excited to share with people my vision on the future of the fiat world as well. So I have a vision on how we can end the Fed and still have a system of sovereign currencies. And so I'm excited to share that with people.
Nice. Sounds very, very exciting. So I'm definitely looking forward to this, like the Bitcoin age and what money will be like in this age. Yeah, that was sort of a good starting point for the discussion I would like to have with you, like credit money, like currency versus money. I mean, it's all like colloquially and commonly people just speak of money. But again, if you kind of, and that's where maybe the theoretical and sort of also academic approach comes in. If you try to distill it down, once quickly finds out that, yeah, there's like sort of, as you elaborated well in your first book, there's like a whole story to money, a whole layered approach. There's different types of money, and some might even be referred to as currency, which currency and money, it's not the same thing. And maybe, if you could sort of, elaborate on this just to start off, the difference between money, maybe currency, credit money. How do all these terms fit together?
Absolutely. And I do that right away in the book because it's important to get our definitions straight. Money is what is accepted by people. Okay. Money is whatever is accepted. That's the basis of it. So that's why dollars count as money today, because people accept it. Right? It doesn't mean it's a good money. And I want to tell that story, why it's not a good money. But dollars are money because people accept it. Currency is what circulates within an area. Okay? So currency is about what actually circulates, and oftentimes currency is a legal definition now. Credit is something that's borrowed. So a dollar is borrowed from a bank. A dollar deposit is borrowed from a bank. It's a liability of a bank. A paper dollar is borrowed from the Fed. It's a liability of the Fed. So credit money is a type of money that came into existence through borrowing. So we have money, we have currency, and we have credit. And today, a US paper dollar or a US dollar deposit at a bank it does satisfy the definition of money, of currency, and of credit money, of course, because that is what it is. It's a form of credit. And that is confusing for people. It's confusing for the world. And it's actually tricked them into this misunderstanding that the dollar is all we have in terms of money. It also brings into the conversation how if you have credit money, it doesn't hold its value. And that's really at the core of the problem there.
Okay, I see. Yeah. Well, I mean, that's interesting to differentiate it in these three forms. You have money, you have currency, you have credit, and obviously they all sometimes are intertwined in the same instrument, as you said, in the dollar, because you in some cases you could consider the dollar actual money, but in some cases it's really like a credit money, as you said. But then maybe my question would be, it also comes down to the sort of different issuers, right? Or obviously, because I think credit money is issued by certain entities, then maybe the dollar as a more lower tier money is issued by other entities, and then currency again. So maybe, I don't know if we can differentiate there as well, and just kind of make our way through this entanglement of all these different terms, so to say.
So let me do one thing first, okay? Because I'll answer your question about who the issuers are and how that impacts everything. But you're asking, it's funny because you're asking questions that are all questions that I've gone through actually during the editing process. Because during the writing process, you write the story and then you go back and read your story and you're like, it it doesn't flow yet. So trying to make it flow, I had to go through these definitions. And what was fascinating is that Satoshi Nakamoto's paper is called Bitcoin, a peer-to-peer decentralized electronic cash system. And so he doesn't use money or currency in his description of what he's trying to invent. He's actually trying to invent cash. So then you have to define cash too. What is cash? Cash is physical money. That's what the definition that I landed on. It's physical money. So if Bitcoin is trying to invent physical money, that means that the instrument that he's trying to invent can be gold without an issuer, or it can replace currency which does have an issuer. So I just want to add that layer in when you ask about who, is that cash can be with or without an issuer in the traditional sense. Today, cash isn't, it doesn't have any gold content, so there's no money that you could associate with like a quarter of a dollar, unless it's a pre-1965, I believe, is the 1964, I believe, is the year they cut off and stopped putting actual silver in quarters in the United States. That aside, cash in theory can be a gold coin, right? So minted by somebody but not issued. So maybe I'll let you ask again to follow up, but I wanted to mention cash first.
Yeah, exactly. And like bringing up cash is instrumental as well, because I think, as you said, it might be issued by somebody, but I think what's also pretty distinctive about cash is that there's like instant settlement, in terms of like, if cash is around and it has been issued, you and me, we can do sort of a peer-to-peer transactions with cash. I can give my sort of quarter that I have in my hand, I can hand it over to you, and then that transaction is like instantly settled, so to say, because I don't have it anymore and you now have it, it's in your possession, and nobody had to kind of intermediate that sort of transaction. And that's, I think, is also quite key about cash, right? That you have this final settlement, which is then again something maybe that's not present in credit immediately, so to say.
Yes, and I'll be a stickler for semantics here. The final settlement is the correct version. It's not necessarily instant, because I can pay you in cash and mail you the cash, but it'll be final when you receive it. It won't be instant, and Bitcoin's blockchain is not instant either. You do have to wait, but it's final when it settles.
I see. Yeah, but I mean, Just one thing that springs to mind here, then, and I hope I'm not like deviating too much, is really if we talk about cash and we have like cash in today's system, it's still present, it's being used less and less, coins and also sort of bills and notes, I mean, Switzerland, where I'm from, we still have sort of a cash culture, so to say, and a lot of older people are really they're really stubborn in letting go of cash, which some believe is good, because I think it was Fyodor Dostoevsky who said it's like cash is coin freedom, so to say. And in that sense, I was wondering, like, again, the cash that we have, it is issued by an entity. I think it's printed in Switzerland by the Treasury, but sort of it resides on the balance sheet of the central bank. And I think it's the same in the US, right? And so my question isn't there also a credit element to this? Because it is somebody's liability, that cash, like in US dollar cash, it is somebody's liability because that entity has issued this. And whenever there's a liability, isn't there sort of also a sort of credit component to it? So just wondering what you're thinking there, because I think there we're already getting into the nitty-gritty of it all, that even like today's cash has like sort of these liability elements to it, sort of, yeah.
We don't have cash that's money anymore. We have cash that's credit. And that's what your question is, and you're absolutely correct. We don't have that form of cash. And if you think about it from the issuing, and I've never said it in these words, but if the Fed is the issuer of cash, do we even have the right to use cash privately anymore if it's issued by a fiat institution that's not actually backed by anything? So people are like, oh, I don't want a cashless society because it takes away my ability to transact privately. That might be true, but you are still being diluted by using cash because it's of the unit of the dollar, which is a credit instrument, which grows in size constantly. And so cash is a liability today. It isn't money. It's not good money, right? It's accepted as currency, therefore people think it's money, but that doesn't make it good money because it's credit. So yes, you're absolutely correct. And Satoshi Nakamoto inventing the cash, what he's inventing is a physical money. So he's inventing a cash that ends up being money. It's a currency because it's used online, right? Where a currency is something that circulates. So it circulates in an online way in the online world. So he invented cash, which ends up being money because it's accepted, currency because it's circulated, and not credit. And so, but he started with trying to invent cash. So it's a whole, it's a jumble of words that honestly, it makes Bitcoin difficult for people to understand, because the first thing that you ask a no coiner, why don't you have Bitcoin? Oh, you can't spend it anywhere, right? It's like people just conflate currency with money, with cash, like all together, without really understanding what any of these things mean.
This show is brought to you by NewHedge. In a market driven by complexity, insight is everything. NewHedge is a dedicated Bitcoin analytics and intelligence platform delivering cutting-edge analysis, on-chain metrics, and real-time market data. With 200 plus proprietary indicators, live derivatives data, and adoption metrics, NewHedge provides the depth and precision that serious market participants demand. Backed by some of Bitcoin's most prolific investors, NewHedge connects traditional finance with Bitcoin's evolving landscape. Gain your data edge today. Sign up for free now at newhedge.io and get 50% off your advanced subscription with the code SIGNAL. Mm-hmm. Yes, I see. Yeah, that's certainly right. And I mean the distinction. Yeah, it's a hard one to grasp. And but I mean, Lynn Alden has in her book, like Broken Money, also made this distinction between like credit, as we're saying, and then commodity. Like you have credit money and you have commodity money. And I think true cash, and correct me if I'm wrong, but is closer to then like actual real cash is close to commodity money. Because then it's not intermediated, but it's still sort of an actual instrument that people can use. And in that sense, Satoshi Nakamoto is trying to, or has tried to reinvent cash, and he's done so in a digital way, which is why Bitcoin can even be seen as sort of a synthetic commodity, so to say, because it has like these characteristics of a commodity. But would you agree? Yeah, that like real cash sort of is or used to be sort of a commodity. That's how it kind of emerged in the first place.
The other side of credit money is commodity money, right? So a non-credit money is essentially by definition a commodity money. And so but cash can be either, right? And so it was one and now it's credit. So it was commodity money and now it's credit money. But a gold certificate issued in the year 1900, before you had the Fed, it was a paper version of commodity money that was also a credit of sorts because it's issued, right? It's issued. It's not the commodity itself. So that's why the definitions sometimes are tough. And it kind of just depends how you want to frame it. And Lynn's book is excellent.
Yeah, exactly. Well, but then if I spin this further, and I want to talk about like, okay, the money, cash. We established this, that there used to be like actual cash in a sense, and nowadays we have like credit cash, so to say, if I want to put it this way, the dollar, how it mainly functions. But I mean, mostly even the credit, the liability cash dollar that we have isn't that widely used in today's economy anymore. It's really this other type of currency, which is the credit money. Like in as in the form of bank deposits, and then maybe even beyond. If you have all these other layers. So maybe we can go into this. Because I think this is issued by banks, and as we said, probably also by shadow banks to a degree. But talk to us about this, like commercial banks, bank deposits, credit money, and how that all fits together.
Yes. So part of my story in Bitcoin age is explaining the source of the problem, which is that the dollar itself is not a US instrument. It is a global banking instrument. It's a global banking dollar. And if you want to be even more specific, you can just call it a global financial system dollar. It doesn't sound as nice because the dollar instruments are issued by banks and non-banks that are financial institutions. So, but for the simplicity of the story, I call it the global banking dollar. And I don't talk about layered money in the book. It's not a sequel to layered money. So I don't use this layered framework really at all. I want to get away from the layered framework in the book and just explain that a credit is a credit. It doesn't really matter who is issuing it. And the central bank is simply a backstop for the banks. So it's just another credit institution. So the dollar in paper cash is issued by the Fed. It's a liability. A bank deposit is issued by a bank. It's a liability. A British bank issues a dollar. It's a euro dollar deposit. It's a liability. A money market fund issues a share. It's a dollar. You don't get to use it until tomorrow, but it's still a dollar. Like you referenced shadow institution. So that's a version of it. There's a lot of versions of the dollar, but the limit to its creation is not truly governed. in any way. We have a Basel Committee, we have a Federal Reserve, we have a Treasury Department. They all and then banks themselves are self-regulating with their own risk departments. So there is a limit on how many dollars are created by all these institutions around the world, but that limit is not well defined by any one person, institution, country, or anything. And it makes the dollar really, in a strange way, too decentralized to control the supply.
Yeah, exactly.
There's
Yeah.
no protocol for it.
Mm-hmm. Yeah, that's a great point. Exactly. Yeah, that's something that recently dawned on me as well. Like today's fiat money, it's sort of decentralized in the sense that there's so many different entities to this system that get to sort of create again then different types of maybe layered money, but in the end it's all sort of functioning as credit, and people are accepting it as money. So exactly, it's really sort of decentralized, but and I think then my question would sort of be, because I think the ultimate limit on how much money there is negotiable, and that's really the tricky thing about the fiat system, whereas like with Bitcoin there's a hard cap 21 million on the bottom level, so to say, on the foundational level, which is non-negotiable. It's just not possible. And on the fiat system it sort of is, because once one entity kind of starts to struggle, another entity can come in and sort of fill in the gaps, but then maybe just trying to dissect it again, who's creating the money now in today's system, because we have like these different groups. Some say it's just the central banks, others say it's the commercial banks, and again others say it's government, MMTers or the MMT guys. So maybe one by one, can you shed some light there as well around your thoughts? Who's creating the money, so to say?
It's a great question. My answer is changing all the time. I'm just going to be honest with you. Because even as you're asking the question, my brain is thinking that it's not even really that layered anymore, in terms of the dollar. It's more a free-for-all. So to answer your question, the money comes from, don't think about it from the issuer's side. Okay? So stop thinking about from the issuer side, because you're the Fed issuing dollars, banks issue dollars, right? How do banks issue dollars? They lend, right? And how does the Fed issue dollars? It buys treasuries. So it lends to the government. Banks lend to people. So actually, where does the money come from? Think about the demand for the money, which in a credit money system is borrowing demand. So as long as there's a marginal borrower that meets the marginal lender, which is most times a bank, but sometimes it's the Fed and the US government, right? But the Fed is also a bank. And the government is the borrower in that position. If the government is willing to borrow, and a person is willing to borrow, and a company is willing to borrow, and there's a bank there ready to issue that loan, that's where the money comes from. So forget about the institutions. The institutions create it. But why? You don't just create money, you have to lend it into existence. So the money comes from the demand to borrow. And why does the quantity of global balance sheets expand and expand and expand? Because the borrower meets the lender at the margin every freaking time. I was going to use the other F word, but everyone has their own rules on their show.
Yeah, exactly. No, but it's a great way to think about it because maybe I'm being too pedantic about this here. But I mean, it's just because I'm being asked these questions all the time as well. With like it's always these categorizing or classifying people. Do you believe, as you said, now are you with MMT people or like people who say the banks are creating the money, and they're loaning it into existence. They don't need any deposits like as collateral. They can just, as you said, borrow it into it or lend it into existence, and these type of stuff or these type of questions. So I mean, as I'm now understanding you, you're telling me, yeah, in the end, it's really the demand, for money, and whenever there's like two people who kind of agree on that, money is being created, and you don't need. It's actually true that you don't need any collateral for this. Probably, usually it is demanded. On the lender side, I guess, that there is some sort of collateral underpinning this transaction, but yeah, you don't need it in the first place, because it's being presented to you or it's becoming part of the equation because once the money is created, so to say. And so you would actually also subscribe to this theory, if I understand you correctly, but you're saying, yeah, in the end, it doesn't really matter because that's just how it works in a credit system par excellence or per definition, Is that a fair summary, so to say?
It is, Pascal, and I'm not trying to dance around your question, but I am at the point where we're trying to flip. We've been trying to explain money. I think I say we, but I just mean Bitcoiners have been trying to explain money for a certain amount of time and in a certain way. But I'm trying to change that. I'm trying to change it. I'm trying to try a different way to explain these things. So I'm not trying to dance around your question of who's issuing, but let's change the way that we're thinking about this. Like blame the banks for issuing loans or blame the Fed for QE. There is another side, which is demand, that causes the expansion. Yes, banks create money, but who's borrowing that money? Companies, governments. Governments. Who's voting for the governments? Who's the shareholder of the companies? It's everyone. So everyone is contributing to a credit money system because credit money system is a borrowing system. So the borrower is also at fault. And I don't use fault, lightly, but if you're asking who's creating the money, well, it's the demand and the supply that creates the money. It's
Mm.
both.
Yes. Yeah, exactly. Yeah. That makes a lot of sense. I mean, probably the question or the reason why I'm trying to double check on this, and double click on this, so to say, is really because in the end, from a practical point of view, again, want to understand, okay, where's the inflation happening, and maybe just let me quickly reframe the questions because I believe, like as you said, yeah, there is demand for money, and obviously banks happen to be the entities which are closest to the ones demanding the money and actually are the ones then also providing it and sort of lending it into existence. But then the question is there the inflation? Is it happening right then if like money is lent into existence? And or is it more the case because I feel like if there's no demand for money and the money is being paid back, so to say, credit money, it can also be sort of be destroyed again. It's sort of lent out of existence or it paid back, and then there's no contract anymore, and that's why it would sort of be deflationary. And so I think that my question is the inflation happening there already, or is like the true inflation that Bitcoiners usually also are all inheres about? Is it really because the central bank sometimes steps in and then sort of um, yeah, make sure there's no deflation, by also then lending their money into existence again, just to make sure no credit money deflation is happening. And that's where the true inflation is at then. Or does this distinction not really make sense? Just trying to
Yes.
ask here.
By the way, I have a T chart tattooed on my arm. I'm just I'm just joking, but uh, uh,
Could be, yeah.
the work that I've been doing over the last couple of years, it does sometimes feel like I just see T-charts right through my contact lenses. Uh, your question about inflation is inflation happens when there is more demand for something than yesterday, right? Or less supply than there was yesterday. So aside from supply shocks, inflation is most of the time driven by demand, right?
Yes. Yeah.
Basic 101. If there's
101
more
economics.
demand, it should drive the price up, right? More demand versus yesterday drives the price. So where does inflation come from? It comes from demand, and demand comes from spending something new that didn't exist yesterday. So money lent, then money spent. That is the inflation. The inflation happens at money spent, not money lent, money spent. So, but as money gets lent, it gets spent. So again, semantics, but the inflation happens when the loan is spent. Now you ask about the Fed. Is the Fed responsible for any of this? We can use two examples. We can use 2010 QE and 2020 QE. 2020 QE moved prices up. 2010 QE didn't. The reason was because in 2020, when the Fed lent to the government spent in a massive, massive, massive way. The 2008-9 spending of the government was basically just to counteract the deflation that was happening, right? To prevent the contraction, which I know you asked about contraction of the system. They can't let it contract because if you let it, if you don't, it's basically if you don't let it continue to expand, then someone will default. Because when you lend money into existence, the interest that the borrower needs to pay back has to be earned. So if there isn't more money in existence, the money that they earn is taken from somebody else in a zero-sum game, then that other person that fails is going to default, and the bank is going to end up contracting. But the bank wants to make sure that there's an ever-increasing amount of money in the system so that it avoids default-linked contraction.
Yeah. No, I think, yeah, because that's where things, in my mind at least now, when I'm listening to you, things are also exacerbated in a sense, like, because I feel like, yeah, I see money, inflation happens, there's money created, and then it's lent, and then it's also spent. And that's where, obviously, if something is spent to the economy, it can potentially push up prices if there's more demand for something, which was yesterday maybe not as much supply, and then, but my thing is then, yeah, the opposite is if it's getting sort of retired because of a default, or just because the demand is kind of retreating, and then you have like an entity stepping in for whatever reason, maybe for good reasons, for bad reasons, you are sort of procrastinating, or, as I said, exacerbating, because then you're not letting a sort of maybe cleansing effect also happen. And I said, again, that's where it's really tricky in the end, because it may be for good reasons, because like deflation, credit deflation, yeah, it's a thing which might be hard. It's like a drug addict who's been on drugs and has been doing great, and sort of now doesn't get any drugs anymore. Yeah, he has to go through this cleansing period, and I feel like it's probably the same. And again, I don't want to put any blame on anyone, but just like structurally, that's how I'm trying to think about this. And if if a central bank steps in with lower tiered money and tries to make it up for something, then that's obviously sort of, from a systemic perspective, exacerbating things, right?
Yeah,
In that
when I think about this, when I think about the central bank creating money, I go back to 2010. That's when people, the people that said, "Oh, QE isn't money printing," those people said QE is just an asset swap because they're buying treasuries from a bank and issuing reserves to the bank. So for the bank, it's just an asset swap. They lose one risk-free asset and they gain another risk-free asset. Technically, that is correct. That's not inaccurate. QE is an asset swap. But if the marginal or if the Treasury Department is borrowing and spending and borrowing and spending, and the Fed is absorbing that debt after a few weeks through the primary dealer system, then the Fed's expansion of balance sheet is ending up in the deposit account of a government contractor or employee. So the Fed is actually issuing the deposit through the daisy chain of liabilities to that government contractor. And by the way, the government contractor or employee spends that money 100% of the time. That's money that gets spent. So inflation comes from there. So can the Fed cause inflation? Yes, it can, but it does take the spending, not just the asset swap. If the Treasury isn't in deficit at the time that the Fed is doing QE, it might not cause it. And we have basically 5 years of evidence, basically the first half of the 2010s, as hard evidence in a QE non-inflationary environment. We have 5 years of that data.
Yeah, exactly. Yeah, and that's very well explained. That makes a lot of sense to me. I mean, in terms of the asset swap, just one thing I wanted to add, because that's also something just recently where it dawned on me again. It is an asset swap, as you said, but that at the same time, I mean, it's just like different assets that are getting swapped here. It's usually like bank reserves or central bank reserves that are being swapped for treasuries. Most of the times, it was also like bonds, treasury bonds with a longer duration. And I think even there you can see if you a central bank reserve, in my understanding, is more like an asset with almost zero duration, because it's almost like actual like a treasury bill or like actual money. And if you swap that, you're taking duration out of the market, because you're kind of scooping up all these treasury bonds and you're filling banks up with shorter term instruments, and that has an effect as well. So even there, like again, as you said, the effect that you described, but this is another effect where it can't be totally neutral just because of this as well, because of this duration effect, I would say, right?
And
Do you have any
and
thought there?
yes, so you're correct that when they do QE, they remove duration from the private hands. It makes the banks more willing to figure out a way to grow their balance sheet in a different way that doesn't involve treasuries. But the removal of duration to get to the spending, remember, because if the spending causes the inflation, then you have to get the bank loses the treasury, buys a corporate bond that wasn't previously going to be issued. So an issuer that is now able to come to the market because the Treasury Department is being absorbed more by the Fed. Then that company can potentially hire an extra worker. And then when that worker gets hired and gets the salary and then spends the money, it's inflationary. But when you get to all the way to the worker, many things have happened, right? And we don't know whether one thing caused the other necessarily.
Yeah, it's
And to
counterfactual,
go back
really.
to our 2010s example, it didn't actually drive aggregate demand up. Maybe all of that QE prevented a deflation. Maybe it was just preventing deflation. And so the counterfactual there is hard to explore. These are just my thoughts on it. Yeah.
Yeah, great. No, it's been really helpful, and it's just fascinating because it's helping me. I'm learning a lot, and it's also helping me to kind of reconfirm thoughts that I had in my head as well. I maybe because we're already almost 50 minutes into talking here, I want to bring two more things up. The bank reserves, the central bank reserves. We've already touched on this. I'd like to ask you on what are they actually for? How do you think about them? And then maybe my last question would be on treasuries and where the treasury comes in, and also like treasury bonds and bills and instruments, how do they fit into the entire money discussion? Because I think that's another important element that we quickly have to kind of unpack here. But if we could start with the central bank reserves and how you're thinking about them, that would be great. And what sort of role they also play within for central banks and with banks,
Reserves do basically one thing. They help furnish interbank transactions in the domestic market. That's all that they do. So the only thing we need reserves for is so that banks can settle with each other at the end of the day when a Citibank customer writes a check to a JP Morgan customer. That's it. Let me just suggest this, Pascal. I don't think we need a central bank anymore after my research and what the thought that I've put into my book, Bitcoin Age, and the design of the future system. I don't think we need a central bank. Banks can figure out a way to settle with each other without a government-sponsored central bank. That's my opinion going forward. So I'm going to basically, not address why I think reserves matter or where I think they fall into the system, because I'm actually thinking in a post-reserves way now, thinking in a post-central bank way. Banks can settle with each other, figuring out a system of reserves with themselves. It's what the Eurodollar system already is, by the way. They don't have a central bank in Europe for dollars. They just settle with Eurodollar balances. It's called a placement. If you've studied your banking, this is called a placement. It just means I owe you. That's what a Eurodollar basically is. It's an interbank IOU. Okay, so I don't think we need reserves. I think it's an obsolete concept. They need reserves so that they can use the government authority to print themselves money in a bailout. That's why they need it. That's why I don't think we need it as a society anymore. Okay? The banks can figure out their own functioning for themselves. The second part of your question, the second part of your question about treasuries.
Maybe just quickly.
Okay.
Maybe just quickly, because now you got me curious, because obviously this is quite a statement that you just dropped here, and I think a few people would sort of be, kind of offended, I could even say. Because I think that's true. Like if you look back in history, it's also worked like this before. There were no central banks, and banks were clearing back maybe in the 17th or the 18th or the 19th century, and even. So I think we have some precedents there when we look into history. But some people then argue, well, but because this didn't work out, central banks were emerging. And what do you say to this argument? Have they emerged for other reasons? Like, as you I think already hinted at, it was because, government was looking for a place to finance itself, or what would you say to these critics,
What the populace understood about the financial system in 1913 is different than what it understands about it today. And if you take a fresh look, I don't believe we need a Fed anymore. And that's the way I'm thinking about it, full stop. I just think we're in a different world with a different understanding and different needs, right? And so our needs as a society, to answer the second part of your previous question, I believe government borrowing, governments together, people associating together, forming a government, using that government as a coordination mechanism for things like defense, using the capital markets to borrow as a country and have that borrowing equate with some sort of monetary form and or currency is part of our future. It describes partly how we operate today, but we have this whole banking sector, basically sphere, that it is blended with sovereign currency and the Treasury Department, the way that we issue fixed income securities and what we consider the dollar. But I believe the dollar can stand on its own. The U.S. Treasury can issue bonds, and all of that dollar-based system stay alive without a central bank. And that is in my forthcoming book, Bitcoin Age, and I am really excited to share the details with people.
Great. That's amazing. I mean, if I had more time, I would obviously ask you on how does this actually work? How will governments be issuing treasuries in a Bitcoin age? But I think we have to reserve this for another time. And obviously people will then have to check out your book. And maybe once I read it as well, I would love to bring you back on the show to maybe explore these topics in more detail. But yeah, I think for the time being, we'll leave it at that. It was just brilliant. Thank you, Nick. Just what I expected. I mean, I learned a lot. I hope my readers, and I guess they have learned a lot, or they will have learned a lot as well. So, yeah, just thank you for taking the time. I have one last question that I ask to every guest on my show. Is there anybody that comes to my mind, comes to your mind, another high signal person, maybe on these topics or maybe even other adjacent topics that we should talk to on this show?
There are a lot of great analysts, out there, and I don't know if you have talked to Jeff Booth. I know many people have read his book, The Price of Tomorrow. What I'm talking about, Jeff talks about that deflation is the natural state of the market. And so that when you talk about why do prices go up, why does inflation happen, you have to talk about credit and credit expansion, the things that we talked about today. But he starts from an even earlier principle, which is that prices should be going down, generally speaking, as people innovate better and cheaper ways to do things. So understanding why a credit money system expands, I think that I've helped you do that today, in that when a loan is issued, it's the principal plus interest that needs to pay back. And so if the interest is in excess of the money that is already in circulation, the only way the bank can have its borrowers make the bank whole is to expand the money supply all the time. So that's why prices go up all the time, is because there's always an expansion of the money supply. But without that, what would they do? Prices would go down. So I think Jeff Booth's deflationary thesis, not even a thesis, it's more an observation that has become a really great framework for understanding our monetary system. So that's the name I would say. I'm a big fan of Jeff Booth.
Nice. And so are many others, because I think he's been recommended to us out of these 21 shows that we've done so far, like 3 times already or 4 times. I don't remember.
You know why?
So
It's hard to be a 0 to 1 thinker and someone that says something that's never been articulated in a way. And that's why Jeff is his book and his thesis is special.
Yeah, exactly. Yeah, it's true. I read the book as well, and obviously at some point I have to make sure I'll get him on the show. But that's a strong argument, like coming from you. So maybe I can use that once I reach out to Jeff. So thank you, Nick. Thanks a lot for taking the time and talking to us today. And yeah, enjoy the rest of your week, and then well, probably also a great weekend, which is right around the corner, right?
Yes, thank you so much for having me, Pascal. I appreciate the time.
Thank you. Bye, Nick. Thank you.